Good morning, everyone. This is the second video that I'm going to record. In this video, I'm going to go over not only the risk metrics by Ben Cowen, but how does it actually play into this idea of cycle theory? I kind of felt like people need to understand what cycle theory is. Not a lot of people talk about it. I know Campbell Finance on YouTube talks about it, and Bob Lucas is probably the best known for cycle theory. In my research, I've tried to find multiple channels, anything I can read on cycle theory. There doesn't really seem to be a lot of information out there, but to me, this is part of the system in order to keep me on the right side of the trade. And in this video, I'm going to talk not only about the risk metrics, but how to combine the two in order to make a very good DCA system. Now, the DCA system, it could be dollar cost averaging, where you just throw money into the market based on the risk metrics. For example, if it's zero point 0.7 or below, you're going to throw in $2,000 a month and then cut it off. There's dynamic dollar cost averaging, which is essentially as this blue line goes down, you're going to throw more money into it. So let's say zero point 0.7 is your cutoff as far as the base that you're going to put money into the market. As it goes down, you would increase it, right? So 2,000, 2,500, 3,000. That's the approach that Cowen takes. I also take that same approach with my retirement accounts. I've been using the system since 2020 in my retirement accounts, and anytime you see these crashes when the blue line goes down, I'm putting more of my money. So a lot of people, they fund their IRAs right off the bat, or HSAs, as soon as they can fund it, January 1st, they're in. For me, I like to spread it out. One, it just helps with financing, but two, I'm also looking at the best opportunities to get in. And again, since 2020 and COVID, I've been looking for a system that's going to help me look at when's a good time to get in. You always say like being in the market's better than beating the market. I agree with that, but to me, psychologically, throwing money into a high and then waiting for it to come back is pretty hard. So the April crash, I put a lot of my for my not 401k, my HSA and IRA in because I knew that was a good buying opportunity, right, to dip that low down to the 0.55. So what are these numbers that I'm talking about? It's a regression model. Ben Cowen is a PhD in engineering, I believe. And what he did is he developed a system using a regression model. Bottom is your dependent variable, right? Or sorry, independent variable, which is your time. So the reason I like this metric, so it goes all the way back to the 1930s, which means you have a ton of data to kind of base this off of. So they do have risk metrics for Bitcoin, and he just came out with gold, which I'm going to start utilizing. But the cool thing about this is there's tons of data to inform your decision, right? So if you're looking here, this is basically the price. So this is the dependent variable. And all he does is plots the relationship between the ebbs and flows of not only recessions, but economic booms and also busts, right? So here, it dropped pretty low, right? And this is right here is the financial, like the housing crisis that we kind of saw. So when you get down to a 0.19, that's probably the best bet to sell the farm. And a lot of people are like, well, it's like doomsday. What are we going to do? And in my mind, if it recovers, it's going to be a huge upside swing potential. If it doesn't rebound, I think we have a lot bigger problems. So to me, this is where I'd be putting in the majority of my cash in is something like this with the 2008 crash. If you come down here to even, the 2000s, when you saw the dot-com bubble burst, that's also a good indication. So all I do is in my retirement accounts, if it's below a 0.7, I dynamic DCA in a certain amount. If it drops to a 0.6 or a 0.5, I put a lot more in. This March was the first time, well, also 2022, it got pretty low where I could deploy a lot of my capital into my retirement accounts. So what I'm going to do moving forward is I'm going to actually start a brokerage account with M1 Financing. I'm going to use the same strategy. The only difference is I'm going to probably start between the 0.7 and 0.8 to build it up, meaning that I'm going to throw money if it's within these two bands. As it grows, I probably won't be as aggressive. So let's say I can get it to 50, 100,000. I'll stop DCing in after zero point 0.7 and maybe look at the zero point 0.6 to the zero point 0.7 metrics, right? The reason being is because then, I'm taking more risk by trying to get up to these higher levels, and I'll kind of show you what that means. But as it drops, I'm going to do the dynamic DCAing in where I'm going to increase the amount. So let's just say I use $2,000. If it's between a zero point 0.7 and zero point 0.8, if it drops to a zero point 0.6, I'll actually add maybe $1,000 extra. The other thing that I'm going to do is use margin in a safe way. I see a lot of YouTubers that are buying ULTY on 50% allocations to their margin, and that really scares me in a downturn. I do think we're going to see a huge pullback at the end of this year, not only for Bitcoin but also stocks, and that really does scare me. So what I'm going to do is maybe borrow $1,000, right? I'd rather have more capital to deploy when the stock market is lower than deploy more capital as it's going up, right? So the old saying of it's better to be in the market than time to market, I completely agree. But that's where my $2,000 allocation is from the zero point 0.7 to the zero point 0.8. I'm building a portfolio, but as it drops more, I'm trying to participate more into it, which again, for me, takes the emotion out of it if I'm just using these risk metrics. And by the way, I've used these risk metrics with Bitcoin and Ethereum, and they work like a charm. I mean, you're really sitting in your hands a lot of the time, especially with Ethereum. But when Cowen puts out a video that says it's time to buy, I don't miss a beat. And there's been 4 or 5 times that I'm like, he's completely wrong. It's not going to happen like that. And 9 times out of 10, he is correct, right? So same thing with S&P. He doesn't talk about this a lot. I plan to do future videos about Bitcoin and also maybe even gold. But for right now, this is kind of what I'm looking at as far as my strategy. So the cool thing about it is if you know what a bell curve is, you can kind of see like a formation of a bell curve. And that is why you are kind of participating in this 50 or zero point 0.5 to zero point 0.6. Again, remember, it's the time of the S&P over the price and how often does the S&P sit in these wristbands, right? So it's over almost 50% of the time it is in this wristband, right? I mean, it's almost 50, right? So that's pretty cool is that 50% of the time, if I was using Cowen's strategy, I'd be participating in the market, right? And if you go to 13%, 3%, so 16%, let's just say, and then a 0.08. So let's just say 16 and a half, just to round up. So he is basically taking profit as the risk metrics goes up. And then when it drops back into this 0.7 to 0.5 band, he's deploying more capital, right? Which is kind of great. If it drops lower, it only spends 17%, 8%, and 3%, 3.5%. So as it drops, that's where my margin is going to kick in, but also I'm going to contribute more money. I really want to start doing more investing in other assets like S&P, Bitcoin. I sold my Bitcoin a little bit ago. I'm still waiting for Ethereum to break all-time highs again. So I'm waiting for 5,000 plus, and I'll start taking profits. And then I'll go home. I won't be involved in the crypto market for another year. I think we're going to see a huge crash, not only in the crypto market, but I also think the S&P. And that's why I'm starting the strategy now, is I wanted to get it built, but I also want to get education out there, right? A lot of people are very emotional. I am too. That's why I needed the system. Is they're like, look at, let's just keep putting money in. But I was tired of buying the top and watching it go down. Like I talked about Ethereum buying at 1,500 my first cycle, which I think was the second cycle overall, maybe the third. And then I watched it go all the way down to $80 during COVID. So that was a gut wrencher to kind of, and I held it. I didn't sell it. I actually bought more when it went down to $80. So the system really kind of keeps you on the right side of the trade. If you look at the S&P, I put this on a weekly scale. You can combine these, and that's what I do is, looking at the seasonality, so the S&P typically has 3 up years and 1 down year as far as the cycles go. But the problem is we've been in such a bull run, right? I mean, this goes all the way back to, 2009, where we're just crushing it as far as like just straight up, right? This is where you'd see these pullbacks come into play. Like I really want to find the April one. So if we can go to April this last year, it dropped all the way down to, 48.34 in the S&P. And if you come to the risk metrics, right, this is right where the crash happened, right, in April, May, that we got down to the point fives. So to me, that doesn't really happen very often, that we get down to the point five, point six, or point four to point five. We never really reached this level, but we did reach this level, which is enough for me to kick in a lot more money. Like I think I maxed out my HSA during this because I was like, I think this is a great time because, instead of just like adding it to a money market or adding it to something where I'm just holding it for a small percentage, I was able to kind of time the market. And if you kind of look at this, it happens at least a couple times every year where you're going to get good buying opportunities. You just have to be patient, right? So this is how I'm using it. I really appreciate everyone's comments. I got a lot of text messages from friends on Facebook. But for me, again, what I'm going to do is still use my retirement accounts. Anything below point seven, I buy. I'm going to start focusing on next year's, as we start preparing for the end of this year, 2025. Hopefully, I have some good buy opportunities in 2026. And then for my margin account, my brokerage account, I'm going to start between the point seven and point eight of just doing like $2,000 a month. And then as we drop lower, hopefully my account grows as it's doing that, and I can leverage not only more money throwing into the market, but then also margin. So I am going to use margin on the account in order to get more exposure. And again, this is going to be an experiment. I'll kind of talk about that in another video. So thanks for watching. I appreciate everyone's time. And if you have any questions, please let me know.